What if I told you there's a strategic advantage kind of lurking in the tax code, a really powerful tool for small businesses that could, well, radically change your bottom line? I mean, potentially sidestepping that burdensome double taxation and maybe even more importantly, slashing your self employment taxes. We're not just talking about, minor tweaks here. We're talking about putting thousands, maybe even tens of thousands more dollars back into your pocket every single year. Today, we're embarking on a deep dive into the world of S corporations. This isn't just about understanding some tax form, okay? It's really about unlocking a secret weapon for your business's financial health. We're going to unpack exactly how an S corp functions, who's eligible to leverage its incredible benefits, and most importantly, the precise mechanisms that lead to those game-changing tax savings.
Yeah, and our mission for you, the listener, in this deep dive is really to cut through all the complexity.
Hmm.
S corporation rules, they can seem like this dense jungle of jargon, right? But we're here to distill them down into clear, actionable insights. We're focusing on the mechanics, the specific details, and the real-world impact that translates into actual tax efficiencies for your business. So by the time we're done, you'll be, well, pretty well informed about a crucial strategy that could fundamentally reshape how you approach business taxation.
Okay, so let's pull back the curtain on this. We hear the term S corp thrown around all the time, right? Especially among entrepreneurs. But what is it really? Is it like a whole new kind of business entity, or is it more of a behind the scenes tax thing?
That's a really fantastic distinction to make right up front. A lot of people assume an S corporation is, a unique legal structure like an LLC or a traditional corporation. But in reality, it's not. An S corporation is simply a tax election. It's a choice available to eligible small, closely held corporations. See, when most companies incorporate, they default to being taxed as a C corporation that operates under one set of rules. An S corporation is just a choice you make with the IRS to be taxed differently. It allows profits and losses to pass directly through to the owners without being taxed at the corporate level first. It's a strategic designation, really, not a separate legal beast.
Ah, okay. So it's a choice. And that choice, that special election, that's the real gateway to tax efficiency then. Which brings us to the core benefit, this flow-through taxation. Can you kind of paint a picture of how that actually works in practice?
Absolutely. This is the fundamental advantage. It's what makes the S Corp so appealing for so many businesses. Imagine a traditional C corporation, right? It earns profit. Okay. Then the corporation itself pays federal income tax on that profit. Then, if that corporation decides to distribute dividends to its shareholders, those shareholders, well, they get taxed again on those dividends. That's the notorious double taxation we hear about. With an S corporation, that whole problem is largely eliminated. All of the corporation's income, its gains, losses, deductions, everything flows directly through to the shareholders' individual tax returns. The corporation itself generally avoids federal income tax at the corporate level. So instead, the individual owners, they're taxed just once, directly on their proportionate share of the S Corp's earnings. And that's true whether those earnings are actually distributed to them or just kept in the business.
Right. So if I'm picturing this, it's not like the money hits this corporate wall, gets taxed, and then moves to me and gets taxed again. It's more like I don't know, a clear conduit or maybe a direct pipeline. The income just flows straight through the S corp and lands directly on my personal tax return. No hidden corporate level tax traps at the federal level, at least.
That's an excellent analogy, the direct pipeline. That's exactly right. This immediate pass-through of income and losses, it directly affects a shareholder's individual tax return. This mechanism offers simplicity and, like you said, helps avoid that corporate double taxation at the federal level. It just means the tax impact lands directly on the shareholder's individual Form 1040 via Schedule K-1. It streamlines the tax process and ensures that single layer of taxation on the profits. #T, who qualifies. Navigating the eligibility landscape for maximum benefit.
Okay, so this flow through, it sounds fantastic, almost too good to be true. It feels like it can't be a free-for-all, right? There must be some specific guardrails, some criteria that make sure a corporation is, the right fit for these particular tax benefits. Who actually gets to jump on this pipeline? What are those critical requirements?
Oh, absolutely. There are definitely rules. And these eligibility requirements aren't just bureaucratic hurdles, okay? They are the fundamental characteristics that ensure the S Corp structure can actually maintain its flow through integrity. First off, the corporation must be a domestic corporation. That just means it has to be formed right here in the U.S. Generally pretty straightforward. Now, interestingly, an S corporation can own 100% of a C corporation. But crucially, they cannot file a consolidated tax return together. Their tax lives stay separate. However, if an S corporation creates something called a qualified S subsidiary, or Q sub, that's where the S corp owns 100% of its stock, then those two entities do file as one for federal tax purposes. The Q sub is essentially treated just like a division of the parent S corp. It simplifies things quite a bit in that structure. Second, and this is honestly where many of the common pitfalls arise, we need to talk about eligible shareholders. The IRS is very, very particular here. Eligible shareholders must primarily be individuals, estates, or certain types of trusts. Now, it's absolutely crucial to understand that an individual shareholder cannot be a non-resident alien. That means someone who isn't a U.S. citizen or a green card holder and doesn't meet what's called the substantial presence test. This is a really common tripwire, especially for international businesses or companies with global investors.
Hold on. So if I'm a U.S. citizen and I want to bring in an investor who, say, lives in London and doesn't have a green card, that's an immediate no-go for S Corp status. Is that right? That kills it.
Precisely. That would immediately terminate the S election. Done. It's a fundamental restriction. It's designed to simplify the tracking of income for U.S. tax purposes. Now, on the surprising side, qualified retirement plans like 401ks or even IRAs and even 501c3 charitable organizations can actually be shareholders in an S corp, which offers some interesting planning opportunities for those tax-exempt entities. But what's explicitly excluded, other corporations and partnerships, they just can't be shareholders. These entities have their own complex tax structures, right?
Yeah.
Allowing them as S corp shareholders would just fundamentally break that simplified flow-through principle that the S corp relies on. These rules, they're really designed to protect that clear pipeline structure we talked about.
Okay, that makes perfect sense. These rules are like the gatekeepers, aren't they? Making sure the S Corp stays true to its intended design. And part of that design also dictates how many people can actually walk through that gate, doesn't it? There's a limit.
Yes, exactly. There's a strict 100 shareholder limit. And that's a really clear signal from the IRS that S corporations are primarily intended for smaller, closely held businesses, not large publicly traded entities. It helps maintain that sort of family business or tight-knit group feel. But here's a really interesting strategic detail, and it's a huge advantage for many family-owned businesses.
Yeah.
The family members treat it as one shareholder rule. For the purpose of counting towards that 100 shareholder limit, an entire family can, under certain conditions, be counted as just a single shareholder. Now, family members here includes common ancestors, all their lineal descendants, children, grandchildren, great-grandchildren, you get the idea, and their current or former spouses. So you could have a business with, say, a dozen family members owning shares, but they might still only count as one or maybe two shareholders towards that 100 limit. That's incredibly valuable for legacy planning, keeping the business in the family without bumping up against the limit.
Wow, that family rule is a pretty big deal for those kinds of businesses.
It really is. And finally, there's one more very important requirement that really simplifies how income gets allocated. The one class of stock rule. An S corporation can have no more than one class of stock outstanding. What this means is that every single share must have identical rights to distributions and liquidation proceeds. It prevents complex profit-sharing schemes that could, muddy the waters for the IRS. However, it's worth noting that differences in common stock voting rights are actually allowed. So you can have voting shares and non-voting common shares. That's great for maybe keeping control within certain family members while letting others participate financially. What's strictly prohibited is preferred stock. That usually carries different or preferential rights to dividends or liquidation proceeds. That would just fundamentally complicate the flow through and allocation of income. So it really forces simplicity. No complex preferred share stuff trying to funnel profits around. It's all about that clean, clear pass-through, making sure the IRS knows exactly whose income is whose.
Okay, so we've laid the groundwork. We know what an S Corp is fundamentally and who fits the bill. But here's where it gets exciting, right? Making that official leap and then critically staying within the lines to keep those really valuable tax benefits. How do you actually make the election to become an S Corp? It's not automatic, is it? You have to sort of proactively tell the IRS, hey, we want this.
That's exactly right. That very deliberate act. The mechanics involve filing IRS Form 25-5P3. That's the election by a small business corporation form. And here's a critical point. This can't be stressed enough. All shareholders, that means both voting and non-voting shareholders, must consent to this election. Their signatures are required right there on that form. It signals their agreement to this S Corp tax treatment. And timing. Wow, timing is truly everything here. This is honestly where so many businesses can make a costly mistake, sometimes a devastating one. Okay, listen. If Form 2553 is filed by the 15th day of the third month of the tax year, so for a calendar year corporation, that's March 15th, then the S election is effective as of the first day of that current tax year, January 1st. You basically get to retroactively apply those S-Corp benefits for the whole year, which is huge. But, and this is a really big but, if you file it even one day later, after March 15th, the election won't take effect until January 1st of the following year. I've genuinely seen clients miss that deadline by just hours, and it meant missing out on an entire year of potential self-employment tax savings. We're talking thousands, sometimes tens of thousands of dollars lost. It's truly a brutal consequence for what seems like a simple timing error.
Whoa, okay, that deadline is a huge deal then, a difference of an entire year of benefits. So it really sounds like planning ahead, marking that calendar, maybe setting multiple reminders is absolutely non-negotiable. Once you've successfully made the election and it's in effect, what happens if new shareholders come into the picture down the road? Do they need to reconsent or sign something for the S status to continue?
No, thankfully, the IRS has simplified that part. Once the S election is properly in effect, the consent of a new shareholder is generally not required for the S corporation status to continue. The status just keeps humming along, basically, unless there's either a voluntary decision by the majority shareholders to end it or some kind of involuntary termination because the company fails one of those qualification rules.
Okay, that's good to know. And speaking of tax years, S corporations generally adopt a calendar year, right? And they file that Form 1120S you mentioned. What's the deadline for that form, and are there any exceptions to the calendar year thing?
Yes, the vast majority, almost all S corporations, operate on a calendar year. It just aligns nicely with the individual tax year of the shareholders. Their federal income tax return, Form 1120S, is due by the 15th day of the third month after the close of their tax year. So again, for a calendar year entity, that's March 15th. Now, if March 15th happens to fall on a weekend or a holiday, the deadline shifts to the next business day, naturally. There is an exception possible, where you could use a different fiscal year if you can establish a valid business purpose for it. But honestly, this is pretty rare and generally requires specific IRS approval. Think maybe a highly seasonal business that has a natural year-end outside of December. For most businesses, though, calendar year and March 15th are the key dates to remember for filing the 1120S.
Right. So, given all these advantages we've been talking about, especially the tax savings, losing your S status would be, well, a real blow, wouldn't it? It seems crucial to understand how that can happen, because the tax consequences of termination sound like they could be significant and probably pretty painful. What are the common ways an S election can actually be terminated?
You're absolutely right. Termination can have major repercussions. It's almost like slamming on the brakes when you were just enjoying that smooth tax ride. There are a few key ways it can happen. First, the shareholders themselves can decide to end it. If shareholders holding more than 50% of the stock, and that includes both voting and non-voting shares, collectively consent to a voluntary revocation, this is a deliberate decision, right? Often it's made for strategic business reasons, like maybe they're preparing for a sale to a buyer who's a C Corp, or perhaps they actually want to take advantage of certain C corporation benefits for some reason. Second, and honestly, this is where most involuntary terminations happen, the corporation simply fails to meet any of those initial qualification requirements we just spent time discussing. This is kind of the silent killer for many S-Corp. If you suddenly, maybe accidentally, admit an ineligible shareholder like another corporation or that non-resident alien we talked about, or if you maybe issue a second class of stock without realizing it breaks the rules, boom, your S election is automatically terminated immediately. There's no grace period, no warning letter first. The status just ends the very moment the qualification is violated. Let's maybe look at a concrete example from the source materials, just to illustrate how fast this can happen. Imagine small corporation. They've been a calendar year S-Corp for, say, 10 happy years, enjoying all the benefits, operating smoothly. Then, on February 1st of the current year, small corporation admits large corporation, which is a C corporation, as a new 40% shareholder. Okay, what's the impact? Well, immediately, right there on February 1st, small corporation's S election terminates. Gone. Why? Because, as we established, C corporations are explicitly not eligible shareholders for an S-Corp. That single change in ownership, even though it wasn't a majority stake, means they no longer meet a fundamental requirement. The S election is lost, and they basically convert back to being taxed as a C corporation right on the spot.
Wow, so it really isn't just about setting it up correctly in the beginning. It's about constant vigilance. Even a seemingly straightforward ownership change, like bringing in a new investor, could trigger a catastrophic tax event if you're not careful. Are there any other, maybe less obvious termination triggers we should know about?
Yes, there's a third specific trigger that's a bit more nuanced. It's called the excess passive investment income rule. This can happen if more than 25% of the corporation's gross receipts come from passive investment income. We're talking things like rents, royalties, interest, dividends for 3 consecutive tax years. But, and this is a really crucial caveat, this rule only applies if the S corporation has prior C corporation earnings and profits, or EMP, on its books. This typically happens if the company started its life as a C corp and then later elected S status, carrying over those old C corp profits. If the S corp was always an S corp, right from day one, this particular passive income rule doesn't apply. It's basically a rule designed to prevent C corp from just electing S status to hold a bunch of investments and avoid corporate tax on that passive income.
Okay, that makes sense. And the consequence of termination, whether it's voluntary or involuntary, it's pretty severe, isn't it? If your S status gets terminated, you can't just flip a switch and become an S corp again the next year, can you? It feels like there's a penalty period or something.
Oh, there is. It's a significant penalty, yes. Once an S corporation election has been terminated, the corporation generally has to wait until the beginning of the 5th year after the year of termination before it can even try to elect S corporation status again. That 5-year waiting period really highlights just how serious termination can be for your tax strategy. Imagine being forced back into C Corp taxation, possibly with double taxation, for half a decade after you've been enjoying those S Corp benefits. It really underscores the importance of staying compliant with all those eligibility rules day in and day out.
All right, now this is where it gets really interesting for our listeners, I think. We've talked about what an S corp is, who qualifies, how to elect it, how to keep it. But now let's dive into the actual numbers, the real nitty-gritty of the tax savings. How does income and loss actually flow through? And what's the big deal everyone talks about with self-employment tax? This is the core, right?
This is absolutely the core reason many businesses choose S Corp status. Okay, so similar to partnerships, S corporations flow through their ordinary business income or loss, plus various separately stated items. These are specific types of income, gains, losses, deductions directly to the shareholders. And these allocations, they're meticulously made on a per-share, per-day basis. It ensures fairness, based on exactly how long each shareholder owned their shares during the year. Very precise. Now, here it is. The major tax advantage. The real golden nugget of knowledge, the thing that often drives the entire decision to elect S corporation status. Unlike sole proprietorships or partnerships, an S corporation shareholder's share of the ordinary business income is not subject to self-employment tax. Let me repeat that. Not subject to self-employment tax. This is true even if that shareholder is actively involved, working day in and day out in the business operations. The only portion of an S corp owner's compensation that gets hit with self-employment taxes, which are Social Security and Medicare, is the reasonable salary they pay themselves via a W-2.
Wow. Okay, stop right there. That is a game changer. And that's where the rubber truly meets the road for your wallet, isn't it? Let's try to paint a clear picture for our listener. If I'm, say, a sole proprietor, maybe a consultant or a freelancer, and I'm making $100,000 in net business income, what's the potential self-employment tax hit I'm looking at versus that S Corp shareholder with the same $100K income? Give us that real-world, tangible dollar difference.
Okay, yeah, let's break that down. It's really stark. For a sole proprietor or a partner in a partnership, pretty much every dollar of their net business income is generally subject to self-employment tax. For 2023, for instance, that tax rate is 12.4% for Social Security, up to a certain income cap, which was $160,200 for 2023, plus another 2.9% for Medicare with no income cap. That's a combined 15.3% on your net earnings from self-employment, after a small deduction. So if a sole proprietor nets $100,000, they're looking at roughly $14,130 in self-employment taxes, right off the top, before income tax.
Okay, $14,130, that's significant.
It is. Now compare that to an S corporation shareholder who also has $100,000 in business income flowing from the S corp. The IRS requires S corp owners who work in the business to pay themselves a reasonable salary for the services they perform. This is key. Let's say, just for this example, a reasonable salary for their role is determined to be $60,000. Okay, that $60,000 is paid as a W-2 salary, and it is subject to payroll taxes, both the employee and employer share of Social Security and Medicare. The total payroll tax on that $60,000 salary would be roughly $9,180. Now, the remaining $40,000 of that $100,000 in business income, that flows through to the shareholder typically as a distribution. And this distribution, this $40,000, is not subject to self-employment tax.
Oh, okay, let me get this straight. In that scenario, the S Corp owner's total hit for Social Security and Medicare is about $9,180 on the salary, compared to over $14,000 for the sole proprietor on the exact same amount of business income. That's a direct saving of around $5,000, just on self-employment taxes alone. That is a seriously powerful incentive. And you're saying this distinction is often the primary reason people make the S election.
Absolutely. It's often the biggest driver, especially for profitable service businesses or single-owner companies where the owner is also the main employee. That potential SE tax saving can be substantial year after year. Now, beyond that ordinary business income, S corporations also have these things called separately stated items. We mentioned them briefly. These are specific categories of income, gain, loss, or deduction that still flow through to the shareholder's individual tax return on their Schedule K-1, but they're reported separately from that ordinary business income figure. Why separate? Because these specific items are subject to special rules, maybe different limitations or potentially different tax rates, all at the shareholder's individual level.
Okay, so what kinds of things fall into this separately stated bucket?
Good question. Common examples include things like net rental real estate income or loss, interest income, dividend income, royalties, net short-term or long-term capital gains or losses. Also, net Section 1231 gains or losses. These come from the sale of business use property like equipment or maybe buildings. They have special netting rules, and if they result in a net gain, they can often be taxed at more favorable long-term capital gains rates. So obviously you want that treated differently than ordinary income. Other examples are charitable contributions made by the S Corp and the Section 179 expense deduction.
Ah, Section 179. That's the one that lets you expense a big chunk of equipment purchases immediately, right?
Exactly. It's a powerful tool for immediately expensing certain assets instead of depreciating them over time. But it's separately stated because it has its own set of limitations, dollar limits, investment limits, and even a taxable income limit that applies at the shareholder's level. So it has to flow through separately. Basically, all the other general income and expense items that don't fit into one of these special categories, those are typically just lumped together in the calculation of the S-Corp's ordinary business income or loss that flows through.
Got it. And as if that potential self-employment tax saving wasn't enough, there's another potentially significant deduction available for many business owners, including S-Corp shareholders, right? Something called the Section 199A Qualified Business Income, or QBI deduction.
That's right. This is another significant benefit. For many S-Corporation shareholders, there's the potential to take what's called a below-the-line deduction. It's often 20% of their qualified business income that flows through from the S-Corporation. Below the line just means it's taken after you calculate your adjusted gross income, AGI, so it directly reduces your taxable income. This QBI deduction can be a really substantial tax benefit, further lowering the overall tax burden on your business profits. Now, there are certain income limitations and specific rules about what kind of business qualifies, but for many S-Corp, it's another valuable layer of tax savings written into the code. It's definitely one of the more valuable recent tax provisions for small businesses.
Okay, let's shift gears just a little bit. Let's talk about fringe benefits, things like health insurance, maybe retirement plan contributions. The tax treatment here can be a bit, well, nuanced for S-Corp, can't it? Especially when it involves the shareholder employees themselves. How do they work, and what are the common mistakes people make here?
Yeah, this is definitely a common area for confusion, and it's really critical to get it right. Why? Because it directly impacts the S corporation's ordinary business income calculation and therefore the shareholder's ultimate tax liability. The rules differ significantly, and it all hinges on the shareholder's ownership percentage. Okay, first, let's talk about fringe benefits provided to regular non-shareholder employees, or even to employee shareholders who own 2% or less of the S corporation stock. For these individuals, the cost of those fringe benefits is generally deductible by the S corporation as a normal business expense when it calculates its ordinary business income. Pretty straightforward. Works just like any other business deduction for employee costs. However, and here's the crucial point, the one that's often missed, the cost of those same fringe benefits provided to shareholders owning more than 2% of the S corporation. That cost is not deductible by the S corporation itself, unless the value of those benefits is explicitly included in that employee shareholder's W-2 income for the year.
Wait, say that again. So if the S-Corp pays my health insurance premium, and I own, say, 50% of the company can only deduct that premium cost if it also adds the amount of that premium to my taxable W-2 wages.
Exactly right. It's kind of a look-back rule. If the benefit isn't added to the W-2 wages, and therefore taxed to the shareholder as income, the S-Corp cannot deduct the cost on its tax return. So, using your health insurance example, if the S-Corp pays the premiums for a 2% owner, those premiums must be reported as additional taxable income on that owner's Form W-2. If they're not reported on the W-2, the S-Corp loses the deduction, which essentially means the company pays more tax because its taxable income is higher. I've seen many businesses inadvertently make this mistake. They think they can just deduct all the benefits paid without doing the proper W-2 reporting for the owners, and then they get hit with disallowed deductions, maybe even penalties if they get audited.
Okay, so understanding that 2% shareholder rule for fringe benefits is vital. It directly impacts the S corporation's bottom line, its ordinary business income, and consequently, the amount of income flowing through to all the shareholders, affecting their personal tax liability. It really sounds like exactly the kind of thing a sharp CPA, maybe like this Mary character from our source example, might encounter in a tax software diagnostic report. One of those flags warning her to double check something before hitting file. Yeah, let's actually put this into a real world scenario. Let's imagine a day in the life of Mary, our CPA. She's preparing the tax return for her client, Acme Company. Let's say Acme was a C Corp back in year one, but they validly elected S status effective January 1st of year two. So Mary's now preparing Acme's very first S Corp return, the Form 1120S for year two. What kinds of common errors or diagnostic messages might her tax software flag? Things that tie directly into these rules we've been discussing, and more importantly, how would she fix them to ensure the reporting is accurate and, they're maximizing those tax benefits correctly?
This is an excellent way to see these rules in action, because these are very common flags that tax preparers deal with all the time. Okay, so Mary's working on Acme's Form 1120S for year two. Her software might indeed pop up a diagnostic report, flagging a few key issues that relate directly to our discussion about ordinary income versus those separately stated items. So Diagnostic 1. The report indicates that a $15,000 gain, which came from the sale of some business use property, was manually entered or maybe miscategorized as ordinary business income on page 1 of the Form 1120S, the main income section. The software, being smart, correctly identified this $15,000 as a long-term capital gain. It probably picked it up from Form 4797, line 9, which deals with gains from business property. The software likely automatically mapped it to Schedule D for capital gains and Schedule K for flow-through as a capital gain item. So the correction for Mary is straightforward. She needs to remove that $15,000 from the ordinary business income calculation on page 1. Why? Because, as we discussed, long-term capital gains from the sale of business use property, what tax pros often call Section 1231 gains, are separately stated items. They do not get included in the S corporation's ordinary business income calculation. They flow through separately to the shareholder's individual return, where they might get taxed at those potentially lower long-term capital gains rates. Only ordinary gain or loss from Form 4797, maybe from depreciation recapture, for instance, would actually belong in that ordinary business income calculation on page 1. Misclassifying this $50,000 gain could lead to an inflated ordinary income figure for the S Corp, which then incorrectly impacts other calculations, like maybe the QBI deduction base, for the shareholder.
Right. So if Mary just leaves that $15,000 sitting in ordinary business income, it totally skews the corporation's ordinary income number. That skewed number then flows through to the shareholders' K1, potentially inflating their ordinary income and maybe messing up other deductions or limitations on their personal return. It really underlines the importance of correctly categorizing every single dollar, doesn't it?
Absolutely. Precision is key. Okay, another diagnostic Mary might see could relate to the depreciation line on Form 1120S, maybe line 14. The report flags a manual override, let's say, of $20,000 for depreciation, and it notes this $20,000 figure seems to include both the Section 179 deduction and the regular MCRS depreciation. The correction here is to separate these two very distinct types of depreciation. MCRS depreciation, that's your standard year-over-year depreciation method for business assets that is indeed deducted in calculating the S-Corp's ordinary business income. Let's say that was $12,000 of the $20,000 total. That $12K belongs on line 14. However, the Section 179 deduction, the remaining $8,000 in this case, is again a separately stated item. It needs to be reported on Schedule K, specifically line 11, and flow through to the shareholder separately. Why? Because Section 179, while it lets you immediately expense assets, has specific annual limitations that apply at the taxpayer level, meaning at the individual shareholders level, not just at the S-Corp level. For instance, for 2023, the maximum Section 179 expense deduction was $11,160,000.
But that limit starts to phase out if a business places more than $2,890,000 of qualifying property into service during the year. And crucially, there's also a taxable income limitation for the individual shareholder. So it must flow through separately. That way, each shareholder can apply their own individual limitations correctly based on their overall tax picture, including income from other sources.
Ah, okay. So that means Section 179, even though it feels like a business expense, needs to bypass the S-Corp's ordinary income calculation and flow directly to each shareholder's personal K1. That way, their individual tax situation, their other income and expenses, dictates how much of that potentially large deduction they can actually claim in a given year. This directly impacts their individual tax bill, which is, again, a significant part of the S Corp advantage getting those deductions applied correctly at the personal level. It's all about making sure the right deduction lands in the right place on the right tax return.
Exactly. And one more common diagnostic Mary might encounter, especially relevant for S Corp, where the owners are actively working in the business. Let's say it flags the section for employee benefit programs on Form 1120S, maybe line 18. The report states that information for health insurance benefits for shareholder employees, perhaps box 84 in the software, wasn't properly completed, or maybe there's some kind of discrepancy flagged. To fix this, Mary needs to go back and confirm. She needs to verify that any amounts deducted for employee benefit programs on the S Corp's tax return only represent health insurance coverage for those employees who own 2% or less of the corporation's stock. As we just discussed, the cost of fringe benefits, like health insurance for shareholders owning over 2%, is only deductible by the S corporation if the cost of those benefits is explicitly included as additional wages on that shareholder employee's W-2. If those amounts weren't included in the W-2, and therefore a 2% shareholder, then Mary needs to remove that cost from the S Corp's deductions on Form 1120S. This ensures that those benefits are properly accounted for and ultimately taxed appropriately at the individual shareholder level, either via the W-2 or by disallowing the corporate deduction.
And this one, again, circles right back to impacting the S corporation's ordinary business income calculation, doesn't it? If those owner health insurance costs were improperly deducted, it means the S corp's reported income is artificially lower, which means the income flowing through to all the shareholders on their K-1s is also incorrect, potentially leading to an underpayment of tax for everyone involved. Wow. These diagnostic examples truly show just how precise you need to be with an S Corp to get the full tax benefit, and frankly, why having a knowledgeable tax professional who understands these nuances is so absolutely crucial. Okay, now we're moving into what some might consider the more technical side of S Corp, but I promise you, listener, it is absolutely essential for any kind of strategic tax planning. We need to talk about something called shareholder basis and another account called the accumulated adjustments account, or AAA. Let's start with basis. What exactly is S Corporation shareholder stock basis, and maybe debt basis too, and why is tracking this stuff so fundamental to managing your S Corp effectively?
Right. Basis is indeed fundamental. You absolutely have to understand it. Think of your basis as your personal investment stake in the S corporation, but specifically for tax purposes. It's not necessarily the same as the market value or your accounting book value, and it's a constantly moving target. Tracking it meticulously is crucial because your basis determines two very, very important things. First, it dictates how much loss, if any, a shareholder can actually deduct on their personal tax return in a given year. And second, it determines how distributions received from the S corporation are taxed, or more accurately, whether they are taxed at all. If you get your basis wrong, you could end up deducting losses you're not actually allowed to take, which could lead to penalties later. Or worse, you might think distributions you're taking are tax-free, when in reality they should be taxable income because you didn't have enough basis.
Okay, so it's like my tax skin in the game. How do I calculate it?
Exactly. The calculation for your ending stock basis in an S corporation is kind of like keeping a running tally, almost like a personal ledger for your ownership stake in the company, specifically for tax. You start with your initial stock basis. That's typically what you paid for the stock, or the basis of property you contributed when you first acquired the shares. Then, you add any additional capital contributions you make to the S corporation over time. You also add all the income items that flow through to you from the S Corp on your K-1. This includes your share of the ordinary business income, any separately stated income and gain items, and, interestingly, even tax-exempt income, like maybe proceeds from life insurance owned by the corporation. Then, from that running total, you subtract a few things. You subtract any cash or the fair market value of property distributions you received from the S corporation during the year. You also subtract certain non-deductible expenses that flow through. And finally, you subtract any loss or deduction items that flow through to you on your K-1, like your share of an ordinary business loss or separately stated losses and deductions.
The result of all that adding and subtracting, that's your ending stock basis in your S corporation stock for the year. Now, here's a very, very key distinction, and it often trips up people who might be more familiar with partnership taxation. Unlike partnerships, S corporation shareholders do not get to include any of the S corporation's own debt, meaning debt the corporation owes to outside banks or third-party creditors in their personal stock basis calculation. It's a big difference.
So if the S Corp takes out a big bank loan, That doesn't increase my personal basis in my stock.
Correct. It does not increase your stock basis. However, an S corporation shareholder does have a separate basis calculation for any direct loans they, the shareholder, make personally to the S corporation. If you, as an individual shareholder, loan money directly from your personal funds to your S corp, that creates what we call debt basis for you, the shareholder, in that specific loan. And then naturally, when the S corporation repays part or all of that loan back to you, your basis in that specific debt is reduced accordingly. It's a completely separate bucket of basis from your stock basis, but it's equally important, especially when it comes to losses.
Okay, two kinds of basis. Stock basis and debt basis for direct shareholder loans. And the big overarching rule with both of these is that they cannot be reduced below zero, right? How does that inability to go below zero actually impact things for the average business owner? What does it mean practically?
That's absolutely right. Neither your stock basis nor your debt basis can be reduced below zero. And this rule is hugely significant. It directly impacts the amount of losses a shareholder can actually deduct in any given year. If your allocated share of the S corporation's losses for the year is more than your total available basis, your stock basis plus your debt basis, those excess losses are suspended. They don't just disappear, okay? But you can't deduct them in the current year, they get put on hold. Similarly, for distributions. Distributions are generally tax-free to the shareholder, but only up to the extent of their stock basis. Debt basis doesn't help here. If distributions exceed your stock basis, then the excess amount typically becomes taxable, often as a capital gain. So, knowing your basis, tracking it accurately year after year, it's basically your shield. It protects you against deducting losses you shouldn't, and it protects you against unexpected tax bills when you take money out of the company via distributions.
If you don't know your basis, you could be flying blind and setting yourself up for a nasty surprise tax bill down the road, maybe when you take a large distribution or eventually sell your business. Let's maybe quickly illustrate the basis calculation using that example of Jane Gray from a source material. Remember, Jane is a 50% shareholder of Gray Corp, an S Corp. Let's say her initial stock basis at the beginning of year one was $25,000. She also personally loaned Gray Corp $20,000 from her own funds at the start of year one. During year one, the corporation repaid $2,000 of that loan back to Jane. And also during year one, Jane received a $10,000 cash distribution from Gray Corp. Now for year one itself, Gray Corp had the following items. Ordinary business income of $30,000, interest income of $10,000, Section 1231 gain of $5,000, and it made charitable contributions of $5,000. Okay, first step, calculate Jane's 50% share of each of those items. That would be $15,000 ordinary business income, $5,000 interest income, $2,500 Section 1231 gain, and $2,500 charitable contributions. Now let's calculate her year one ending stock basis. Start with the initial basis, $25,000.
Add income share, 15 Talpiro OPI plus 5 go to care, interest plus $2 is 5K or 20 to 131 game, plus $22,500. Subtract distributions, negative $10,000. Subtract her share of charitable contributions, a deduction item, that is $2,500. Equals Jane's ending stock basis is $35,000. Okay, now for her debt basis, this is separate. She started with the $20,000 she loaned the company. The company repaid $2,000 of that loan principal during the year. So her ending debt basis in that direct loan is $18,000, $20,000, $2,000.
Right. So at the end of year one, she has $35K in stock basis and $18K in debt basis. And the key takeaway is just how much these numbers shift based on the business's activity income, losses, contributions, distributions. You absolutely must track them accurately every year to stay compliant and, frankly, to make smart tax decisions. Okay, speaking of losses, let's really zero in on that tax basis limitation for losses. This sounds like a critical rule for S corporation shareholders, especially if the business hits a rough patch. You want to be able to deduct those losses to offset other income, right? But this rule can stop you. It must feel like a real punch to the gut if you have a legitimate business loss, but then find out you can't actually deduct it on your tax return that year.
It is, absolutely. And it's a rule that can definitely catch people off guard and lead to a lot of frustration if they weren't anticipating it. The core rule is exactly as you said. A loss flowing through from an S corporation can only be deducted by a shareholder on their individual income tax return up to the extent of their total available tax basis. And remember, that's their stock basis plus their basis in any direct loans they've personally made to the S corporation. You add those two together to get your total loss limitation amount for the year. Now, if a shareholder's allocated share of the S Corp's losses for the year is more than their total available basis, that excess loss isn't gone forever, at least not right away. It gets suspended. It's carried forward indefinitely, just waiting in the wings until the shareholder's basis is somehow reinstated in future years.
Okay, so how does basis get reinstated so you can use those suspended losses?
Basis gets reinstated by any of the items that normally increase stock or debt basis. Primarily, that means future income or gains flowing through from the S-corp or the shareholder making additional capital contributions or maybe even loaning more money directly to the corporation. Now, there's a crucial ordering rule here for how basis gets restored when you have income after having losses that reduced basis. Any future increases to basis, like, say, next year's business income, must first go to reinstate any debt basis that was previously reduced by losses. You have to restore that debt basis back up to its original amount first. Only then does any remaining income go to increase your stock basis. You can't choose to restore stock basis first if debt basis was previously used up by losses. That order is fixed.
Debt basis first, then stock basis. Got it.
Right. Now, here's the real potential pitfall, the use it or lose it aspect. While those suspended losses can, in theory, be carried forward indefinitely, there's a catch. If a shareholder disposes of their S-corporation stock, meaning they sell it, or the company liquidates, or they gift it away before their basis has been fully reinstated and those suspended losses have been utilized, then those suspended losses that haven't yet been deducted are permanently lost. They just vanish. Poof.
Yeah.
Gone forever.
Yeah. This means if your S Corp has had maybe a string of losses, reducing your basis to zero, and you decide to sell the business before it turns profitable again and generates enough income to restore your basis, you could be leaving valuable tax deductions on the table completely unused. It's actually why some shareholders, if they anticipate losses exceeding their basis, might strategically make additional capital contributions or maybe make a direct loan to their S Corp before year end, just to create enough basis to ensure they can actually deduct those anticipated losses in the current year. It's a key planning point. Let's walk through Jane Gray's example again to really illustrate this tax basis limitation in action. We established her beginning year 2 stock basis was $35,000 and her debt basis was $18,000. So her total available basis at the start of year 2 is $53,000, $35K plus $18K. Now let's imagine Graycore hits a rough patch in year 2 and incurs a significant ordinary business loss of $120,000. Jane, being a 50% shareholder, her allocated share of that loss is $60,000. Okay, applying the rule. In year 2, Jane can only flow through and deduct losses up to her total basis of $53,000.
So on her personal tax return for year 2, she deducts $53,000 of the $60,000 loss allocated to her. This deduction immediately has consequences for her basis. It reduces her stock basis first. So her $35,000 stock basis is reduced all the way down to $0, using up $35,000 of the $53,000 loss. Then, the remaining loss allowed, $35,000 of $18,000, reduces her debt basis. Her $18,000 debt basis is also reduced all the way down to $0. So at the end of year 2, both her stock and debt basis are zero. What about the difference? Her share of the loss was $60,000, so she could only deduct $53,000. That remaining $7,000, $60,000, $53,000 becomes a suspended loss. It's carried forward to future years, just waiting for her to get some basis back.
Okay, so she got a big deduction in year 2, but not the full loss, and now her basis is wiped out. What happens next year if things turn around?
Good question. Let's fast forward to year 3. Let's say Graycore has turned things around and now has ordinary business income of $60,000 for year 3. Jane's 50% share of this income is $30,000. Okay, first things first. Remember that $7,000 suspended loss Jane had carried over from year 2. The first thing that happens with this year 3 income before it even increases basis is that the suspended loss gets utilized against it. So that $7,000 suspended loss from year 2 is now effectively deducted against her year 3 income. It reduces the amount of year 3 income that actually flows through and becomes taxable to her. So her net taxable flow-through income for year 3 after applying that suspended loss is $23,000. $30,000 income share, $7,000 suspended loss used. That $23K is taxable to her in year 3. Okay, now let's look at how her basis gets reinstated from that $30,000 of year 3 income. Remember the ordering rule. Income first reinstates debt basis. Her debt basis was zero at the end of year 2, but it was originally $18,000 before the loss hit it. So the $30,000 of year 3 ordinary business income first goes to reinstate her debt basis. It increases her debt basis from $0 back up to its original amount of $18,000.
This uses up $18,000 of the $30,000 income share. Now there's $12,000 in income left over, $18,000 used for debt basis. That remaining $12,000 then goes to increase her stock basis. Her stock basis was also zero at the end of year 2. So starting at $0, it increases by this remaining $12,000, bringing her ending year 3 stock basis to $12,000. So at the end of year 3, Jane's stock basis is $12,000 and her debt basis is fully restored to $18,000. And she successfully used her prior year suspended loss.
Wow, that's a fantastic, detailed walkthrough. It really demonstrates how meticulous tracking and truly understanding these basis rules allows shareholders to effectively utilize losses for tax deductions, even if those deductions get delayed a year or more. And it shows the absolute importance of generating future income to unlock those valuable suspended losses. It's clearly a key piece of strategic tax planning. It also really drives home the point that if your S Corp is consistently losing money and you don't have enough basis, either from initial investment or subsequent income, those losses could be completely wasted tax deductions unless you actively manage your basis, maybe by making additional investments. Okay, so we've tackled basis, which is critical for loss deductibility and the initial taxability of distributions. But there's this other crucial internal account for S Corp that you mentioned earlier, the accumulated adjustments account, or AAA. What exactly is its purpose and why is it so vital? Especially maybe for companies that might have a history as a C Corp before they became an S Corp.
Right, the accumulated adjustments account, or AAA. It's another layer of tracking within the S corporation itself. Think of it as an internal corporate account that effectively tracks the accumulated undistributed earnings and profits of the corporation, specifically during the years it has been an S corporation. Its primary purpose, really, is to help determine the taxability of distributions made to shareholders. This becomes particularly important in situations where the S corp might have pre-existing C corporation earnings and profits, EMP, on its books from a time before it made the S election. Essentially, AAA helps distinguish between distributions that are coming from earnings that have already been taxed at the shareholder level because they were earned during S Corp years, versus distributions that might be coming from those old, untaxed at the shareholder level C Corp earnings. It's like a special ledger within the S Corp to keep track of its S Corp earnings pool.
Okay, so it helps differentiate S Corp earnings from potentially older C Corp earnings when money comes out. How does this AAA account balance change? What makes it go up or down?
Good question. AAA generally increases with the same items that increase shareholder basis from income primarily. The S corporation's ordinary business income and its separately stated income and gain items. However, there's a key difference from basis. AAA does not include tax-exempt income. Why? Because AAA is tracking income that has been taxed or will be taxed to the shareholders. Tax-exempt income hasn't been, so it doesn't belong in AAA. Conversely, AAA decreases with the items that generally reduce basis due to losses or expenses. This includes ordinary business losses, separately stated losses and deductions, and also those non-deductible expenses, though again it specifically excludes expenses related to generating tax-exempt income, as those don't really consume previously taxed earnings. And importantly, distributions made to shareholders also decrease the AAA balance. Now here's an interesting quirk and a key difference from basis. While distributions cannot reduce the AAA balance below zero, the AAA can actually go negative if the S corporation incurs losses and deductions that exceed its positive AAA balance. So losses can drive AAA negative, but distributions stop at zero. This distinction between how losses and distributions affect AAA is a subtle but important nuance.
Okay, that difference is interesting. Losses can make it negative, but distributions can't pull it below zero. Can we use the gray core example again to see how AAA works over time?
Absolutely. Let's use gray core again for an AAA example. Picking up where we left off with Jane. Let's assume gray core started this S election life with a zero AAA balance at the beginning of year one. Okay, remember gray core's year one items. Ordinary business income, OBI, $30,000. Interest income, $10,000. Section 1231 gain, $5,000. Charitable contributions, $4,000. Note, slightly different number than basis example for AAA illustration. Cash distributions made during year one, $21,000. Calculating gray core's year one ending AAA. Start with beginning AAA, $0, add ordinary business income, plus $30,000. Add interest income, taxable income, plus $10,000. Add section 1231 gain, taxable gain, plus $5,000. Subtract charitable contributions, deductible expense reducing earnings, negative $4,000. Subtract cash distributions, negative $21,000. Subtract cash distributions. Gray core's year one ending AAA balance is $20,000. This $20K represents the cumulative S Corp earnings that have been taxed to the shareholders but not yet distributed. Distributions up to this amount and up to shareholder basis would generally be tax-free returns of capital. Okay, now let's look at year two. Remember, in year two, gray core incurred that significant ordinary business loss of $120,000. Let's assume there were no other income items, deductions, or distributions in year two. Start with year one ending AAA, $20,000. Subtract the ordinary business loss, negative $120,000. Subtract the ordinary business loss. Gray core's year two ending AAA balance is $100,000. See, as we said, losses can indeed drive the AAA balance negative, reflecting the cumulative net losses that have flowed through to shareholders during the S Corp period. Finally, let's look at year three. Gray core had a recovery, generating ordinary business income of $60,000. Again, assume no other items or distributions in year three. Start with year two ending AAA, $100,000. Add the ordinary business income, plus $60,000. Add the ordinary business income. Gray Core year 3 ending AAA balance is $40,000. It's still negative. This means that even though the company was profitable in year 3, it still hasn't fully refilled the AAA deficit created by the prior year's large loss.
Future income will need to continue replenishing AAA back towards zero and then into positive territory before distributions can be considered as coming from AAA again. This is especially crucial if Gray Core had any old C Corp E&P lurking on its books, as distributions made while AAA is negative could potentially tap into that E&P and become taxable dividends.
Right. So understanding and accurately tracking AAA is absolutely vital, isn't it? Especially, as you said, if a corporation previously operated as a C Corp and then elected S status, carrying over those old earnings and profits. AAA really helps determine the tax-free portion of distributions versus potentially taxable dividends. It ensures you're not unexpectedly taxed on distributions that actually represent those previously taxed S Corp earnings. It's truly a vital tool for making sure distributions are taxed as favorably as possible and for overall long-term tax planning. It just helps you avoid an unpleasant tax surprise when you take money out of your business, letting you manage the flow of cash and profits effectively. Hashtag tag outro.
Well, that was certainly a deep dive, wasn't it? We've journeyed through the fascinating and, let's be honest, incredibly strategic world of S corporations. We've definitely uncovered some truly significant tax advantages that go way beyond just, simple compliance.
From sidestepping that really dreaded double taxation that can plague C Corp to the potentially massive self-employment tax savings on a shareholder's ordinary business income, which is often huge, and even adding in the potential for that 20% qualified business income deduction. S Corp really offers some powerful tools for small businesses to keep more of their hard-earned money.
That's absolutely right. And navigating these complexities, which, yes, can seem a bit daunting at first glance, is precisely what unlocks the full tax potential of choosing to be an S corporation. Being well informed about these specific rules, understanding the eligibility requirements, getting the election mechanics right, the absolute necessity of meticulous tracking for shareholder basis, and understanding how that accumulated adjustments account works, all of this directly translates into smarter financial decisions for your business. It's really about learning how to leverage the tax code strategically to your advantage, leaving more of your profit right where it belongs, in your pocket, or reinvested in your business.
So, as you, our listener, consider your business structure, or maybe as you reevaluate the one you currently have, remember this thought. The right tax selection isn't just about ticking boxes on a form. It's truly about strategic advantage. It's about actively sculpting your financial future. How might a deeper understanding of these nuanced rules, these details we discussed today, and perhaps, a good conversation with a qualified tax professional who really gets this core, how might that reshape your financial landscape? How much more of your hard-earned profit could actually end up in your hands? The difference, as we've seen today, can be truly staggering.